Hello and welcome to this session. Learning Outcome LO3, Understand Global Financial Risk Management. In today's interconnected world, businesses face financial risks that cross borders. Managing these risks is crucial for maintaining profitability and stability. In this session, we will explore the key aspects of global financial risk management and the tools used to mitigate these challenges. Global financial risk management involves identifying and managing risks in international operations. These risks arise from currency fluctuations, interest rate changes, and political instability. Businesses must manage these risks to protect their financial health. Tools like forward contracts and interest rate swaps are often used. Understanding these risks is the first step in effective management. Currency risk stems from fluctuations in exchange rates. It affects import and export pricing and the value of overseas assets. For instance, a UK company invoicing in USD may see reduced revenue if the pound strengthens. Tools like forward contracts help manage this risk. Businesses must carefully monitor exchange rates. Interest rate risk impacts borrowing costs and investment income. Variable rate loans are particularly vulnerable. Tools like interest rate swaps and fixed rate financing can mitigate this risk. Businesses must diversify funding sources to reduce exposure. Monitoring global interest rate trends is essential. Credit risk involves the potential default of foreign customers or borrowers. This risk is higher in countries with weak legal systems. Tools like credit insurance and trade finance instruments are vital. Businesses must perform thorough credit checks. Managing credit risk ensures financial stability. Political risk arises from instability in a country, such as regime changes. This can disrupt operations and contracts. Country risk analysis and political risk insurance are key tools. Diversifying market exposure helps mitigate these risks. Businesses must stay informed about geopolitical developments. Liquidity risk involves the inability to convert assets into cash. This can be due to capital controls or market collapse. Holding reserves in multiple currencies is a common strategy. Access to global credit lines is crucial. Centralized treasury management enhances liquidity control. Global businesses face varying tax laws and banking regulations. Non-compliance can lead to fines or loss of licenses. Strong internal controls and local legal advisors are essential. Automated compliance systems can aid in managing these risks. Staying compliant ensures smooth international operations. Risk mapping is a visual tool to classify risks by likelihood and impact. It helps prioritize focus on high-risk areas. Businesses can better allocate resources using this method. It provides a clear overview of potential threats. Risk mapping is a fundamental step in risk management. Scenario analysis models different global situations and predicts financial outcomes. It is used in planning and contingency budgeting. Businesses can prepare for events like trade embargoes. This technique helps in understanding potential impacts. Scenario analysis is crucial for strategic planning. Sensitivity analysis measures how changes in one variable impact financial metrics. It helps determine exposure levels and guides hedging decisions. Businesses can identify key vulnerabilities with this tool. It is used in budgeting and investment planning. Understanding sensitivity is key to risk management. Enterprise risk management integrates all types of risk across the business. It treats financial risks alongside operational and reputational risks. A holistic approach improves risk oversight. Businesses can align risk management with strategic goals. ERM is essential for comprehensive risk control. Treasury teams manage liquidity, currency exposure, and funding. Centralized functions improve efficiency and oversight. Businesses can better control financial risks this way. Treasury management aligns with global finance strategies. It is crucial for managing complex financial operations. Diversification spreads investments across countries and currencies. It reduces dependency on one market or economic condition. Businesses can mitigate risks by diversifying suppliers and revenue sources. This approach enhances financial stability. Diversification is a key strategy in global risk management. Various tools help manage global financial risks, such as forward contracts. Currency options and interest rate swaps are commonly used. Letters of credit guarantee payments in international trade. Political risk insurance covers losses from disruptions. These instruments are vital for risk mitigation. International institutions play a role in managing global financial risks. The IMF stabilizes exchange rates and provides emergency funding. The World Bank supports economic development. The BIS sets global banking standards. These institutions shape how businesses manage financial risks. Global financial risk management is vital for cross-border operations. It protects profitability and ensures strategic objectives are met. Businesses must be prepared for currency volatility and regulatory differences. Effective risk management supports long-term success. Ignoring these risks can be detrimental. Businesses use a mix of tools to reduce exposure to global risks. Techniques like forward contracts and sensitivity analysis are applied. Real-time data collection is crucial for effective management. AI systems enhance risk forecasting capabilities. These techniques protect profits and shareholder value. Structured and real-time data is vital for risk management. Businesses track FX exposure and cash flow for better decision-making. Global interest rate feeds aid in loan planning. Customer credit data prevents bad debts. Effective data management supports risk reduction strategies. Risk management techniques have associated costs and benefits. Hedging contracts may involve fees, but they stabilize cash flow. AI systems require investment but improve decision-making. Businesses must weigh operational complexity against benefits. Effective risk management enhances shareholder value. Effective risk management benefits shareholders by stabilizing earnings. It builds investor confidence and improves access to capital. Businesses can expand safely into new markets. Cost control through risk management preserves profit margins. These factors enhance long-term shareholder value. In conclusion, we've covered the essential principles that provide a strong foundation for implementing effective financial strategies with confidence. Global financial risk management is vital for protecting cash flow and investments. Businesses can leverage tools such as forward contracts and AI to mitigate risks effectively. Taking an integrated approach to risk management not only builds long-term shareholder value, but also ensures strategic consistency across borders. Should you have any questions, please contact us on 07484361688. Our team is always happy to help. Thank you for your attention. See you next time.